Right, let's talk about cryptocurrency. Specifically, let's talk about Donald J. Trump and cryptocurrency, a combination that sounds less like a sound financial strategy and more like the answer to a security question you've immediately forgotten. When the latest Trump-branded digital token, Trump Coin, first launched, the headlines were, to put it mildly, not exactly glowing. You saw things like, Trump's new crypto stumbles out of the gate, another Trump venture, another underwhelming debut. Pundits called it boring, a low-energy launch for a high-energy personality. It seemed destined to fade into the digital ether, just another forgotten JPEG of a frog in a hat. But then, something truly baffling happened. As the world was writing it off, a completely different set of headlines surfaced. Trader turns pennies into millions on Trump token. Early backers see 10,000% gains on failed Trump crypto. It was financial whiplash. How could one part of the internet declare it dead on arrival, while another used it to buy a private island? It makes no sense, like a D-rated restaurant with a line around the block. So, here's the central burning question keeping you up at night, right next to existential dread and your neighbor's dog barking at a leaf. How does a supposed belly flop create life-changing wealth for a select few? Is it just free market magic or something more structured? This isn't just a weird coin story. It's about how modern financial hype machines work, and how they can be engineered so certain people get paid no matter what. A failed launch followed by explosive profits isn't a contradiction. It's a feature. Time to lift the hood and look at the engine, even if it's a hamster on a wheel with a fancy paint job. Alright, let's break down the launch itself, because the what happened is crucial. When a new crypto token is born, it's not like a company going public with the New York Stock Exchange, ringing bells people in suits. It's more like someone shouting free pizza in a crowded park. There's chaos, a mad dash, and a high probability that you're not actually getting any pizza. The token was released onto a decentralized exchange, a DEX. Think automated, think 24/7 digital flea market. Anyone can list anything for sale. It was a stealth launch. No pre-announced countdown. The token just appeared. The devs dumped a massive supply into a trading pool paired with a known crypto like Ethereum, framed as fair to stop bots. In reality, insiders were ready. For hours, nothing. Low volume, flat price. Online, a collective yawn. It looked like a flop. That quiet mattered. It let insiders buy huge amounts at rock-bottom prices without spiking the market. They cornered supply, like buying every Super Bowl ticket for $1. Then marketing roared. Influencers, crypto sites, forums, hype everywhere. Retail buyers poured in. They saw the name, they saw the hype, and FOMO hit hard. As the public is still frantically buying, pushing the price ever higher, the early insiders begin to sell. They start dumping their massive holdings onto the very market they helped create. The price, which had shot up so dramatically, begins to plummet just as quickly. The pump and dump is complete. It's a classic, brutal, and depressingly effective maneuver. The Trump coin was what is known in the crypto world as a meme coin. Its value was derived entirely from the meme itself, the brand and image of Donald J. Trump. People weren't buying a piece of a company. They were buying a cultural artifact, a digital bumper sticker. Ultimately, the token's reason for existing was to be traded. It had no other purpose. When a project has no fundamental value, its price is based on nothing more than collective belief and momentum. This is where things go from speculative to forensic. Because cryptocurrencies run on a public ledger called the blockchain, we can actually follow the money. And, when you do, you often find a story. In the case of Trump Coin, one wallet address stands out. Let's call it the mega wallet. In the opening moments of the token's existence, when the price was just fractions of a penny, this mega wallet received a colossal amount of the total supply. We're talking a significant percentage of all the tokens that would ever exist. This wasn't a purchase on the open market. This was a direct transfer from the creators of the token. Now, what did the owner of this mega wallet do? Did they hold on for the long term, believing in the project's future? Of course not. As the pump began and the public started buying in, driving the price up, the mega wallet began to systematically sell. Not all at once. That would crash the price too quickly. Instead, it sold in calculated chunks, bleeding its supply into the market to extract the maximum amount of money without spooking the herd of new buyers. On-chain data shows a relentless series of transactions, each one converting the worthless Trump coins into millions of dollars worth of stable Ethereum and spendable Ethereum. The impact of these sales on regular buyers was, honestly, devastating. Imagine you're a small investor. You see the hype, you buy $500 worth of Trump coin near the peak, dreaming of it going 10 times higher. But what you don't realize is that for every purchase you make, a massive invisible seller, the mega wallet, is offloading thousands of dollars worth of tokens on the other side. You and thousands of others are essentially handing your money directly to this anonymous wallet in exchange for a rapidly depreciating asset. You are providing the exit liquidity, which is a fancy Wall Street term for being the sucker left holding the bag. This single wallet, by its actions alone, was able to control the token's entire life cycle. It received the tokens for free, waited for the public to pump the price, and then cashed out for millions, crashing the price in the process. This isn't a free and fair market. It's a rigged game. The outcome was predetermined from the moment that initial transfer was made. The small buyers never had a chance. They were simply the fuel for the insider's payday. The transparency of the blockchain is a double-edged sword. It allows us to see the crime, but it doesn't do anything to stop it. We can watch the heist happen in real time, but unfortunately, we're powerless to intervene. So, if the token was designed to enrich a few anonymous wallets, where does the Trump family fit into all of this? Did they own that mega wallet? Well, the truth is both simpler and, in a way, more cynically brilliant. The creators of Trump Coin reportedly paid the Trump family a massive upfront licensing fee. It was just for the right to use Donald Trump's name and likeness. They weren't partners in the project. They were selling their most valuable asset, the brand. This is the key to the whole operation. The Trump family's profit wasn't tied to the token's success or failure. They were paid before a single token hit the public, whether the price moonshot or crashed to zero. Irrelevant to their bottom line. They cashed the check and walked away. This model insulates the celebrity from project risk. They get the upside of a big upfront payment, none of the downside of a collapsing asset or angry investors. It's the financial equivalent of getting paid to judge a baking competition, and then leaving before you have to taste any of the cakes. Think about the incentives. A celebrity gets a multi-million-dollar check just to lend their face. Do they have reason to care if a project is legitimate, sustainable, fair to investors? Absolutely not. Their goal? Secure the biggest fee possible. The project creators are happy to pay because the celebrity endorsement draws public hype, provides the exit liquidity, and lets them execute a pump and dump. The licensing fee is just a marketing cost to get the machine running. Oh, you sweet, innocent summer child. This isn't an anomaly, it's a business model. The celebrity crypto cash-in has become a depressingly common feature of the digital landscape. Donald Trump is not the first, and he certainly won't be the last famous person to lend their name to a questionable crypto project for a quick and easy payday. He's just the latest inductee into a rather crowded grift hall of fame. Consider the case of Logan Paul and his infamous CryptoZoo project. He promised a fun, blockchain-based game where you could buy eggs, hatch animal NFTs, and earn crypto. He used his massive YouTube platform to hype it relentlessly, drawing in millions of dollars from his young fan base. But the game never worked. It was a buggy, non-functional mess. The money disappeared, and investors were left with nothing. Logan Paul, however, and his insider friends allegedly made millions before it all came crashing down. Sound familiar? A famous face, a grand promise, and a pile of money for the insiders, while the public gets burned. And it's not just YouTubers. Rapper Soulja Boy has been involved in so many questionable crypto promotions, he could probably teach a masterclass on it. He famously promoted a token that crashed spectacularly, and when confronted by angry fans who lost money, his response was, to put it charitably, less than sympathetic. Or look at Kim Kardashian, who was fined over $1 million by the SEC for failing to disclose that she was paid $250,000 to promote a crypto token on her Instagram. The pattern is always the same: a celebrity with a huge following, a large, undisclosed payment, and a project that enriches the insiders while leaving retail investors in the dust. This business model preys on a fundamental human weakness: trust in familiar faces. We are wired to believe people we recognize, whether they're actors, musicians, or politicians. Scammers know this. They use the celebrity as a human shield. When you question the project, you're not just questioning an anonymous developer. You're questioning your favorite celebrity. This creates a powerful emotional barrier to skepticism. The celebrity gets their upfront fee, the developers get their exit liquidity, and the fan is left with a worthless token and a feeling of betrayal. It's a symbiotic relationship between the famous and the faceless, paid for by you. Let's drill down on the most important lesson in this entire sordid affair. the upfront fee. This is the magic ingredient that makes the whole scheme work. When a project's creators or its celebrity endorsers are paid a large sum of money before the project even has a chance to prove its value, their incentives become completely disconnected from yours, the investor. Your success depends on the long-term health and growth of the project. Their success was guaranteed the moment the wire transfer cleared. Think about a traditional investment. If you invest in a startup, the founders typically own equity. They only get rich if the company becomes successful, and that equity becomes valuable. Their financial success is directly tied to the success of the business. Their incentives are, at least in theory, aligned with their investors. They want the company to grow so they can get paid. But with the upfront licensing fee model, that alignment is completely severed. The celebrity endorser has zero financial incentive to ensure the project is well-run, legitimate, or provides any value to its users. They've already been paid. This creates a moral hazard of epic proportions. Why bother building a real working product if you can make more money with less effort by simply selling the hype? The business isn't about creating value. It's about creating a convincing story long enough to cash out. The developers who paid Trump's licensing fee weren't investing in a long-term vision. They were paying for a key that would unlock a vault full of public money. The celebrity endorsement was that key. Once the vault was open and emptied, they didn't care what happened to the key or the vault. So when you see a new project, especially one with a big name attached, the most important question you can ask is not, what does this project do? What is the roadmap? The most important question is, how are the insiders and promoters getting paid? Are they getting paid in tokens that vest over a long period, giving them a reason to stick around and build? Or did they get a massive check on day one? If it's the latter, you should be extremely cautious. Their victory doesn't depend on you winning. In fact, as we've seen, it often depends on you losing. So here we are at the end of this journey through the murky swamp of celebrity crypto launches. The story of the Trump coin is not really about Donald Trump. It's not really about cryptocurrency either. It's a timeless story about greed, hype, and the age-old art of the con, just dressed up in new, confusing digital clothes. It shows how a famous name can be weaponized to extract money from the public, with a system perfectly designed to enrich the people at the top while leaving everyone else to clean up the mess. It's a masterclass in making millions from perceived failure. The lesson here is deceptively simple, yet it's one people seem to forget over and over again. Always check the incentives. Before you put a single dollar into any project, whether it's endorsed by a politician, a movie star, or your favorite TikTok dancer, do your homework. Dig into how the founders and promoters are compensated. If their payday is guaranteed up front, while yours depends on the fickle winds of market sentiment, you are not an investor. You are the exit strategy. You are the person they are planning to sell to. Don't let the star power blind you. A famous face is not a substitute for a solid business plan, a useful product, or ethical behavior. In the world of crypto, it's often the opposite. It's a giant, glittering red flag, a signal that the project's marketing budget might be bigger than its development budget. The crypto space can be exciting and revolutionary, but it is also a minefield, littered with traps laid by sophisticated players who know how to manipulate human psychology for profit. Your best defense is not to try to outsmart them at their own game. It's to refuse to play. So the next time you see a celebrity shilling a new can't-miss digital coin that promises to change the world and make you rich, just remember the Trump coin. Remember the flatline followed by the pump. Remember the mega wallet. And remember the upfront fee. Ask yourself, is this an investment or am I just the fuel for someone else's rocket ship? Because more often than not, in this wild and unregulated space, if you can't figure out who the sucker at the table is, it is almost certainly you. And that, as we've seen, is how a failed launch can make someone else a shocking amount of money.